Property is seen as the most preferred option when it comes to long-term investment or rental income. Investing in real estate is anyway the traditional choice of Indians. However, with all this comes the problem of tax. The ever-changing taxation rules have made it quite complicated. Let us know under what circumstances tax liabilities are created on property and under which scenarios tax exemption can be availed. If you own a house or a flat, whether it is vacant or let out, you must know how income from house property will be shown at the time of tax calculation and how it is exempted. Gross total income of a person includes many things, including income from salary. It also includes income from house property. Income from house property means income from rent. For this calculation, the annual value of the property should be known. In general, the estimated value of rent that comes from renting out the property, that is its gross annual value. Tax and investment expert Balwant Jain says that you can keep a maximum of 2 properties for your use. There will be no tax on it. Whether you live in 1 or 2 properties, if you have taken a home loan, you can avail a deduction of up to 2 lakh rupees on the total interest. If you own more than 2 houses, then it will be considered that all the properties other than the 2 have been rented out and the rent earned as per the market rate will be shown as income, which is taxable. Let us know under what circumstances income from house property will be taxed. Number 1. If the house is rented out throughout the year. If the house is rented out for the whole year, then the annual rent will be considered as the annual value of the property. From this, the value left after deducting municipal tax, 30% of the standard deduction will have to be deducted. Also, interest on home loan or repairs loan will also be tax exempt. The rest of the value will be included in your income. Number 2. If the house remains vacant for some months of the year. Vacancy allowance is available for the period of time the property is vacant. That is, only that portion of the taxable rent will be included for the time the property was on rent. For example, if the rent is paid for 8 months and the property is vacant for 4 months, then only 8 months' income would be taxable. However, to show that the property was actually lying vacant, the taxpayer should maintain records. Number 3. If the property is self-occupied or unoccupied. If the property is self-occupied, that is, used by the taxpayer for living, then the annual value of such property will be 0. 2 properties can be shown to be self-occupied. If there are more than 2 properties, then the rest of the remaining property will be treated as on rent and the tax will have to be paid on the basis of the estimated rent, whether the taxpayer is residing in it or the property is lying vacant. Number 4. If the property is on rent for some time and is self-occupied for the rest of the time. Now, if the property is let out on rent for some time and is in own use for the rest of the time, the income from the house property for the period of self-occupied will be treated as nil. Taxable rent will be calculated for the time the property is on rent. If a part of the house is rented and the rest is self-occupied. Often, people rent out a part of the house they are living in. For example, if you live on the ground floor yourself and rent out the first floor, then in such a situation, the rent from the portion which you rented out shall be treated as taxable income.